Hi guys, let's do a quick example of general ledgers. It's an example on page 64 of that Kaplan textbook, and I have a screenshot of that, and I'll share that over in the video as well. Now they are not in that illustration or example, they are not asking for journal entries, but we'll pass it because we are beginners and we need to know how these entries are passed for practice purposes, and then we'll go for journal ledgers and prepare those ledgers as well. Okay, now Matthew started a company, and in the first 9 days of the business he has done these transactions. I'll just read out for an understanding and then we'll go ahead. On 1st January, Matthew buys 10,000 share capital in the newly formed company, meaning he is introducing capital 10,000 to start the business. 2nd January, Matthew buys supplies worth 4,000 and pays by check. As I said, we'll consider it for cash as well, because when we pay cash check, people go and get money. So cash, will not open another account for that. Okay. Bought supplies. Supplies are the things whatever he needs, maybe for office use. We will consider them purchases. Then Matthew buys a delivery van for $2,000 and pays by check. Buys vehicle for cash. Then Matthew buys 1,000 of purchases on credit. 1,000 purchases. So purchases on credit on 4th January. Then on 5th January, Matthew sells goods for 1,500 and receives a check of this amount. Sells the goods for 1,500. Okay. Receives check meaning cash, not receivables. If he purchases on credit, then we'll create payables as well. Or sells on credit, then we'll create receivables. On 6th January, on 6th January, Matthew sells all his remaining goods for 5,000 on credit. Now he has receivables. 7th January, Matthew pays 800 to his suppliers by check, payment to suppliers. 8th January, Matthew pays rent of 200 by check. Now let's pass these entries one by one and then we will prepare the ledgers as well. So let's say this is January 1. What entry? Matthew, rather we'll say first entry. Save space. Matthew buys shares, meaning introducing capital. Capital increased, cash increased. Cash is, as we discussed earlier, cash is asset. Increase in asset of the business increased with $10,000. And what is the other impact of this entry? Other impact is equity, is introducing capital. So capital is increase in capital is credit, 10,000. On January 2, buys supplies for 4,000 and pays by check. Purchases for cash. How much was that? 4,000. Purchases debit and cash credit 4,000. Entry 3. I'm a bit faster, but if you need any more details, you can comment and I'll give you that information as well. Entry 3. On January 3, Matthew buys a delivery van for 2,000. Delivery van, motor vehicle, is an asset. Motor vehicle, 2,000. Increase in asset is, we agreed, is debit. What is happening on the other hand? How how is he paying? He is paying through cash. So cash is reducing by 2000. Decrease in asset is, we agreed, credit. So that's the entry. 4th January, Matthew buys 1000 of purchases on credit. So purchases on credit. Now this time, increase in purchases, yes. How much was that? 4th January, $1,000. Purchases, increase in purchases, debit, but this time it's not cash. We got another account, payables, because he purchased these things on credit. Increase in payables liability, increase in liabilities is credit. Okay, 5th January, Matthew sells goods for 1500 and receives check of that amount, sales for cash. How much? 1500. So cash is coming. Increase in asset, cash. Entry 5. Increase in cash 1500. Debit. Sales, interest income, rental, royalty, commission, all these things are income, and we agreed that increase in income is credit, like liabilities. Okay, now he is making sales, income, so sales, credit. 6th, sells all his remaining goods for 5000 on credit. Now this sale is not for cash, credit. We had payables, now we are getting receivables. Receivables is an asset, the customers that will pay later. 5000. Debit. Increase in asset is debit. Receivable is an asset. Sales is making sales of 5000. Increase in sales is, we agreed, credit. 7th January, Matthew pays to his supplier by a check. We had payables, so he is making a payment to his creditors, payables. So cash is reducing, whereas the payables is also reducing. Though we said liability, increase in liability is credit. So now liability is decreasing. Payables decreased by 800. So payables debit. Now what is the other impact? Cash. He paid cash to his supplier. To reduction or decrease in asset, we agreed, is credit. Last and the final entry, 8th January, Matthew pays rent of 200. Rent is an expense, income statement item. Increase in expense is debit, and decrease in cash is credit. So rent expense of 200, debit, and the cash, credit. How much is that? Same amount, 200. So we have 8 entries. Now these entries for this example were not really required. He was asking for general ledgers only, but as we are learning, so it was a good opportunity to learn these entries. Now we'll prepare ledger accounts. Whatever items we have in these entries, for each item we need a ledger account, T account, as we discussed in the previous lecture. Now, but the difference is we need to recognize in the elements of financial statements we discussed, we have items related to the financial position and performance. Performance related items are for the year. They will go, they will be transferred to profit and loss and khalas khatam. But for balance sheet or financial position items will have an opening and closing balance that will never end till the business is a going concern. So for all these items we need to open a T account, general ledger account. The biggest one should be cash because we have the most of the entries are in cash account. So if we don't need that many entries, so only one entry, two entry, we don't need that much space. But I'm afraid we'll need bigger space for this cash. First entry, cash 10,000. We understand we'll post 10,000 in cash account. Which side? Debit side. Debit side. What are we going to write here? The other part of the second entry, whatever is being credited against this, we'll write it here, capital. Don't forget, opposite head, whatever is coming in the opposite entry, we'll write it here. Okay, because it tells cash is being debited with capital. Capital introduced and cash is debited. Now we need to open another account for capital as well because we have that. We'll not have that many entries. We don't need that much space, but we need a ledger account, capital account. Same entry. Now capital. It will 10,000 is going to the capital account, but which side? Credit. Against what? 10,000. Against what? Cash. Because the other entries being debited in cash. Entry 1 posted. Entry 2 purchases 4,000. Let's open an account for purchases as well. We'll have more than one entry in this account, so we need some space for that. Okay. Now purchases debit for 4,000. Purchases debit 4,000. What is the opposite head? Cash. We are spending cash on purchases. Cash is reducing, reduction or decrease in asset is credited. Okay, we agreed, and this both heads are posted. Entry finish. Entry 3, motor vehicle. We need another ledger. This ledger is balance sheet item. Here we have already two financial position items. Motor vehicle. Remember, motor vehicle expense profit and loss item, but motor vehicle financial position item. Increase in asset is debit 2,000. Against what? Cash. We spend 2,000 cash on what? Motor vehicle. So entry 3 done. 4, purchases. We already have a purchases account being debited for 1,000. 1,000. Against what? Payables. Purchases not for cash, for payables. 1,000. Entry 4 done. 5. Cash to sales. We made sales of 1,500 for cash. We need to open another account. Another account for sales. Again, this is P&L account. Okay. Where were we? We were here, I believe, on fifth entry. 1500 sales for cash. Sales being credited, cash debited. How much? 1500. 1500 is cash is coming against sales. We made sales of 1500 for cash. Cash in sales is being credited. 1500. Fifth entry is posted. Why sales credit? Sales is income, increase in income is credit. Don't forget, this logic will take time, but you need to understand that. Increase in income credit, we write the opposite head through which, whether it is credit sale or cash sale, this is cash sale. 1500 is also being debited on the cash side or debit side of the cash account. Entry fifth is done. Sixth, receivables to cash, a receivable to sales. He made sales of 5000, big sales, 5000. But this time it's not against cash. He couldn't sell it for cash, he sold it for on credit, so receivables. I'm sorry if you can't read it, but this is receivables for 5000. Do we have receivables account? I don't think so. So we need to open an account for receivables as well. Receivables is our customer from whom we still need to receive money. And this is an asset account. Increase in asset is debit. 5000. Entry posted. Which entry? Here, sixth, number 6. Receivables. He made sales on credit. Now he has receivables by 5000 and booked sales of 5000 as well. Now entry 7th. 7th entry is, what is that? Payable to cash. He paid cash to payables. Do we have payables account already here? No, we still need to open. This is opposite to receivables. Payables are our suppliers whom we still have to pay. Liability. All these are receivables, payables. Statement of financial position accounts. These accounts will always have opening and closing balances. So on which entry we were working? 8th. Payables. We already have payables. I believe we don't, because here is an entry, purchases to payable of 1000. So purchases. So I forgot to post this entry in the payables, my mistake. So let's book it now. The second part of entry 4, payables, credit against purchases, 1000. Okay, purchases, because here we have purchases for payables, but I forgot to create an account for payables, so that entry is there. So second part of this entry 4 was missed. Sorry for that. Okay, now we are working on payables, entry 7th, because I realized that we are making payment to the payables, but we don't have any payables. So then I realized we definitely missed something, and I found it here in entry 4. Now 7th entry, payables to cash. Payables reducing because we are paying them. How much? 800. What are we paying them? Cash. Cash is reducing now because we paid to the payables. How much? 800. Entry posted. Khalas. 8. Rent. We need to open a small account for rent as well, because there is only one entry. Rent. What happened to rent? Paid rent of 200. Rent is an expense being paid in cash. So 200. Here in the cash account as well, rent 200. So even ASN3 is done. Now the second part, all these accounts, especially the statement of financial position accounts, we need to close them and balance them. Both sides should be balanced. How we do it, we'll see that. But for financial performance or income statement items, we'll take whatever is the balance there, we'll transfer it to the profit and loss account for the year, and it will not have that closing balance and opening balance for the next year. These are accounts for the year as well, year only. Okay, now how we do that? Simply we'll work on the cash account and we'll see how to do that. First of all, we get a rough idea which side is bigger. Mostly you will understand, you don't need to always sum up and find how much is that, which side is bigger, but just having a glance you will identify which side is bigger. Whatever side is bigger, like here we have 10,000 plus 1500, 11,500. I think this side is bigger, so write this on this side as well, 11,500. That is our objective. These both sides should be balanced, equal to the bigger side. Now this side is not adding up to this 11,500. Whatever amount is missing, do we have calculator? Whatever amount is missing, we'll put it here. Now here we have 4,500. This side is 4,500 short of 11,500. We wrote that amount here and balanced it. That's how we balance it. Simply, whatever is missing, look at the bigger side, write that amount at the bottom of that, and the other side should also be the same. Whatever is deficiency, shortage, write it there. Now, this is the balance for the year. Balance carried forward. That will go to next year. Opening for the next year. This is debit balance, so it will come on this side. Brought forward 4,500. Cash balance. Next year. Remember, next year. Now, how do we decide this is debit balance or credit balance? Whichever side is bigger, that is the balance. Whichever side is bigger, debit side bigger, debit balance. Although we write it on opposite side. Why we write on opposite side? To balance it off. To meet the deficiency, to fulfill the deficiency, shortage. This side is lighter, this side is heavier. So we are putting that balance over there to make it level, to make it equal to this side. So that's why it's here. But this balance written on the credit side actually is debit balance. Don't forget, debit balance. Whichever side is bigger, that is the balance of the side. We'll bring next year, we'll bring it as opening balance brought forward. We'll have the same account, same thing for this as well. Capital account, what is the bigger side? 10,000. We'll write 10,000 on this side as well. And then the balance will come here, 10,000. And we'll say carried forward to the next year. Next year it will come on this side. I don't have space, but brought forward and it will come on this side here, 10,000. Because this is credit balance, written on debit balance, but we know the capital balance or credit side is bigger. This is credit balance and it will come on credit side when it becomes opening for the next year. Now, motor vehicle. First we'll deal with financial position accounts to make it simple. Motor vehicle. What is the bigger side? 2,000, debit side. We'll write 2,000 on this side as well. And whatever is the shortage, we'll write it here. and that will be our carried on balance. For the next year, we'll come here and we'll say brought forward 2000. In the same way, we'll deal with that receivables. This side is bigger, have 5000. We'll write at the bottom of the credit side 5000. Whatever is the deficiency, we'll write here and make it balanced. Now this is balance carried forward. Going to the next year. Next year it will be our opening balance brought forward 5000. Payables. Here we have this side is bigger, credit side is bigger, 1000. We'll write it here. Here as well, 1000, the bigger balance. 1000. Now which side is smaller? Of course this side is smaller. How much shortage? 200. We'll simply write 200 here and make it balanced, 1000, 1000. But here we say this is carried forward. This is balance actually. Balance carried forward. Go to the financial statement position. This balance will go to the financial position balance. Do we have any other financial position account? No, I don't think so. Now we deal with these financial performance, income statement items. Same way. Rent 200. We'll write 200 here. Now to make it equal, we'll write 200 here, but this balance will not be taken to the financial position. It will not be there in the statement. We'll transfer it to the profit and loss. We'll say P&L. Transfer it to profit and loss. Okay. Same thing we'll do with sales. We have sales of 5000 plus 1000, 6500. 6500. We'll write here 6500. And the difference we'll put here 6500. Take it to the profit and loss. Income. This amount will go to the P&L. That's our income for the year. Now which account is open? This still need to close. This purchases. Bottom 5000. This side is bigger. We'll write 5000 here as well. Purchases. Now purchases. We'll put the difference here 5000. And it will go to profit and loss account or trading account. I'll not get into that detail, but that's how we do it. Practice it as much as you can, because these entries and ledger accounts are very basic thing but very important. Throughout your career, you will have to keep these things in mind. If you are not very strong in these things, you will have problems. So thank you so much for watching this video, and if you have any questions, comment. And if you are interested in previous topics, the links I'll write in the description. Thanks a lot.